Fundstrat Global Advisors. It's good to see you. I have your notes of your strategy outlook, in which it's titled Less Crisis, More Opportunity. It's like 63 pages long, Tom. I mean, if you need 63 pages to tell me why next year is going to be good, maybe you're trying too hard.
Well, we figure if it takes you a year to go through it, you'll be into 2024.
Yeah. You just forget about next year. I hear you.
Yeah. I think 2023, there's so many arguments that the probability of a double-digit gain in 2023 is far higher than people expect. But I think it does start with inflation and the Fed, because, people talk about monetary policy lags, which is true, but it affects both inflation and the economy. Inflation has already fallen by half in just the past few months and is annualizing at 4%. This is before we've really seen the bite of the monetary hikes. On top of that, earnings could do better next year than expected because, things like the PMI, the dollar, and supply chains are actually supports for earnings next year. And I think that maybe the most important thing to consider is two other things. One is that it's rare for stocks to have back-to-back declines. In fact, in a year after a decline like this, and you say, well, earnings have to be good for stocks to have double-digit gains, that's not true. Out of the 21 instances stocks had declines in a single year, the following year, 18, were positive years. 7 of those had negative earnings growth. So stocks can do quite well next year as long as we're talking about this crisis on inflation ending. And I don't know. I mean, I just think today's FOMC, they do have to make some changes because, the second paragraph there says the Russia-Ukraine war has been an accelerant to inflation. Oil and wheat are below pre-invasion prices. I think that has to come out. And if that does, to me, this is a Fed that may has a little bit less work to do because you don't have the war inflation pressures. That's going to be a more predictable Fed, and I think that's good for markets. I've asked the question at the top of the show, what does the market need to hear to go higher? What don't you want to hear today? Well, I think the biggest risk is if the Fed says, well, we've had progress on inflation, and it's visible, because remember, last FOMC, and several Fed members said there hasn't been any visible progress on inflation. We've had 2 months now of soft inflation. 3-month annualized inflation is down to 4%. It's been cut in half. But if the Fed says that doesn't matter because we don't trust forecasts and all we care about is wage inflation, well, that would be quite hawkish. But that would be something I think the bond market would challenge. I mean, the 2-year yield is telling us the Fed has one hike and that's it. The 2-year yield after today is going to be below Fed funds rates. And I think, to me, that's why they would have to be quite hawkish to shock markets. And there's a possibility the markets would just challenge the Fed on a view like that. Maybe, I mean, it's time for, Jack Nicholson and a few good men. You can't handle the truth. Because if he says, well, we've had progress, but wage inflation is still too high, that's the truth. They believe that. That is in part why they are as hawkish as they've been, and why some think they'll be higher for longer, because wages have become pretty sticky. That's a great point, Scott. I'm just saying the bond market, it's not going to be what the stock market believes. The bond market right now will call the Fed's bluff on that statement, because, again, not only does terminal rates dropped below 5, the 2-year is lower. So we would need to see almost the entire term structure move back above 4%. As many of your guests have pointed out, if you look at interest rates, only the 2-year and 3-month, actually only the 2-year is above 4% right now. So the rest of the bond market is below Fed funds rates. Jim Lebenthal has a question for you, a fellow bull.
Yes. Hi, Tom. Won't call you Farmer Tom, but Scott said something, the good judge said something at the beginning of the show, that regardless of what the Fed's going to do, there's a heck of a lot of tightening that they've already done, and the effects are just now being felt. Here's my question to you. Let's dance with that. Let's say there is a slowdown in the first half of next year, the lagged effect, maybe earnings growth, maybe even goes negative this quarter or next. Isn't it quite likely that the second half of next year you get a reacceleration in earnings, assuming the Fed doesn't go higher than 5%, key assumption, and that the market will start seeing that early in 2023? Do you think that thesis carries water?
Yes, Jim. I mean, when we're talking about what earnings matter to the markets, especially at the end of 2023, it's not 2023 delivered earnings, it'll be 2024. And if we do have a valley of earnings in the middle of 2023, well, since 1920, the stock market has bottomed before earnings 11 out of 13 times by an average of 12 months. So the stock market would be discounting a valley that you're describing. And even bearish strategists for 2024 are talking somewhere between 240 to 250 on earnings. Believe it or not, at a 3.5% 10-year, since 1930, the median PE is close to 20 times. So it would imply that we would be exiting 2023 at a 5,000 level for the S&P, and that's above our target for 2023.
So, Tom, you have a fair value on the S&P for next year of 47.50. 17% higher than where we are now. Joe told me yesterday, I mean, he's obviously sitting right next to me now, but he said in overtime yesterday, and I think the exact words were, I'm worried about Apple. So if Joe's worried about Apple and the market itself seems to be worried about mega cap tech falling out of favor, can you get anywhere close to that target if mega cap tech doesn't participate?
It would be tough because it's, collectively the tech sort of juggernaut is, close to 40% of the S&P. But I would say I think there's tailwinds, and we talk about it in our report for tech in 2023. But most importantly, if yields are flat, that's PE support. And when companies and households want to find their way out of a wage inflation problem, which is what we have today, there's only three solutions. One of them is invest in technology to replace labor. That's tech top line. Or it's policy changes that either try to get immigration higher or improve participation rate. But the easiest path is actually technology spend to replace wage inflation. That's bullish for tech.
Yeah, look, I mean, the street is out in force today defending Apple specifically. Evercore, Morgan Stanley, UBS, Loop, everybody reiterating either top pick, outperform, or buy. No big shock. I mentioned Joe. He has a question for you on something he's thinking about, which might be stimulating for stocks or perhaps not. But I'll let him ask it.
Hi, Tom. So the last couple of years, clearly buybacks a tailwind for markets. Understanding the economic environment being a difficult one in 2023, you're going to lose buyback growth. Can we still reach your S&P target without buybacks?
It's a good question. I mean, the buyback math in the past was cost of money was cheap, so companies could borrow at low cost and buy back their equity. The nominal return for equity is still high because valuations have come down and they're still producing earnings and cash flow. But another thing to keep in mind is, there's close to $7 trillion of cash from companies that are earning 4% on that cash now. And their debt is termed out 7 years, so they're not reflecting higher interest rates for another 5 or 6 years. And that by that time, the Fed could be cutting. So I think in a way, companies are going to still benefit from this higher cost of money, even if they do fewer buybacks.
Hey, Tom, I appreciate it very much. It's a big day.
Thank you.
Great to add your voice to this conversation. That's Tom Lee of Fundstrat joining us. Last word, Carrie, to you real quick.